Please feel free to ask questions. To interrupt. Um, and I won't be looking at the chat window. So in case you want to ask a question, either you raise your hand or you just directly talk. Um, if there is a feedback loop with somebody's microphone, I will probably shut off all the microphones except mine. But please feel free to turn on your own so that you can ask a question. Okay. Um, well, last week we have been talking about the organization of the insurance sector. That is to say, we introduced the largest world insurers, and on this occasion we have seen that the Chinese insurers were growing larger and larger. We talked about business lines, um, and business lines, in fact, they may differ by their business model, but in the case of France, they are written down in the Code de l'assurance, Code des assurances. Then we have been introducing the concepts of density, that is to say the average expense on insurance per inhabitant in a jurisdiction, the concept of penetration, that is the percentage of GDP which is expended on insurance every year, the asset, which is another way to rank the insurance companies or the relative importance of the insurance sector from a country to another. Then we'll be discussing, quite quickly, the presence of insurance in various countries. I've been discussing at large what captives are, and we were talking about distribution. So let us go back to distribution. In fact, the reason why distribution should be taken into account is that basically it isn't featured in any, it isn't featured when you read, for instance, books on the economics of insurance, especially microeconomics. You won't find anything about distribution. Well, in fact, it explains, or it is quite useful to understand what really happens in this sector. So first, we may introduce the players in the field of distribution. So insurance contracts can be sold through various distribution channels, and sometimes many channels at the same time. That is to say, I'm not saying that AXA is only selling through its agents, okay? But there are available distribution channels, and we will see what are the market share of every one of these, okay? And of course, these distribution channels must be registered or licensed to distribute insurance. Since insurance distribution is regulated, and it is regulated by different body of laws, and hence different license than risk carrying, that is to say the business of insurance itself. Okay. I don't know in what order I should start, but for instance, let's talk about bank assurance. We've been talking about this. Bank assurance simply means branches, bank branches are distributing insurance contract of so that may save some distribution costs, because it means you can use an already existing network. Plus the thing is, of course, that when people come to a bank, not always, but sometimes they are interested in an insurance contract for various reasons. For instance, if they're looking for a loan to buy a house or a car, they might be interested as well in a house or a car insurance, okay? And plus, of course, in the case of life insurance, when you do have your personal account in a given place, it might be interesting to add a savings account next to your check account, okay, or your ordinary account. So that's why bank assurance. Then direct writing means, in fact, insurance is underwritten by company employees, and albeit this might seem the most obvious way to deal, it is not, because insurance companies are first risk carriers and not obviously distributors. Okay. Maybe the most antique ways of distributing insurance were through independent entities. Those who have an exclusive contract with a given company are called agents, or agents généraux also, in the case they are larger than first level agents. And then brokers when they don't have an exclusive contract with a given company. Okay, so agents are referred to a given company, an agent AXA, for instance, while brokers are supposed to supply customers with various with a whole range of insurance products coming from various carriers. It is quite usual, especially in France, that agents team up with brokers so that they can complete the spectrum of contract they can supply. And the most usual such combination being that the husband is agent with a given company, while the wife is broker or has a brokerage firm in order to complete the supply of insurance products for the customers. Okay. And then there might be other means which are peculiar to some countries, so I won't be going into this. But maybe I should make it precise that a website could be either direct insurance, okay, when the website is organized and run through the insurance company itself, in which case it must have a license for distributing insurance product as well. So this is such as Direct Assurance, for instance, which is a subsidiary of AXA, or those websites could be comparison engines, the comparateurs d'assurance, in which case usually there are brokers. Okay, they're directly brokers, but in fact the structure, which the website as a structure, is usually registered as a broker, albeit it can be underwriting only for a given company. Okay, or for some companies such as comparison engines, but most comparison engines, albeit they appear as brokers, in fact they were designed to funnel customers toward a given carrier. For instance, if you look at the most widely used insurance search engine in France, which is Le Lynx is a subsidiary of the UK Admiral Group. And of course, the very good thing with an insurance search engine is that you ask the customer questions about what he's looking for, and hence you can ask your competitors what they are offering for the customer. That's the point with comparison, but you can as well tune up, tailored offer for that customer. So it gives you a competitive edge, and Admiral Group is one of the breakthrough firms in the UK insurance sector. There are not many firms making it to the top on the UK market because the UK market is very competitive, and there are not much margins for the carriers because all the margins are squeezed by the brokers. Hence, the genius of Admiral Group was to build a broker which was very innovative, being an insurance comparator. Okay. So even the newest technologies, in fact, they can be inserted in this typology by interpreting it correctly. So now, why I told you about all this? Simply because when you look at, these are countries of the European Union because it's enough, okay? But when you look at European countries, you will see that the structure of distribution is very different from one country to another. Okay, for instance, let's start with life insurance. What we see with life insurance, for instance, is that there is much green there, and green means bank assurance. And as you see, bank assurance is dominating in Malta, in Portugal, in Italy, in Turkey, in France, in Spain. Elsewhere it's not that dominating, especially if we look at if we look at German-speaking countries such as shall I say Germany, of course, but also those countries which are influenced by the German model or by Allianz itself. So Slovenia, Bulgaria, Slovakia. What we see there is that agents are dominating. While if we look at English-speaking countries such as the Netherlands, if we look at English-speaking countries, the brokers are dominating even in the field of life insurance. Okay, well, and now if we look at non-life insurance, the picture is a bit different because agents are even more dominant in German-speaking countries such as Italy and Turkey. Oh, sorry, such well countries which were influenced by the German model for obvious reasons. Because of course, as you know, Turkey was heavily reliant on Germany at the beginning of its own industrial revolution. So by the time insurance developed, and this, in fact, had some influence on the future path of the Turkey insurance sector. Well, whatever. In fact, you see there clearly that there is an agent-based model. Okay, in Slovakia, Italy, Turkey, Slovenia, Germany, while some markets are more reliant, in the case of non-life insurance, for instance, on direct writing, such as the Hungary's market, as well as the French market. And the reason why there is direct underwriting on the Bulgarian or on the French market is very different. In the case of France, the reason there is that for a non-life insurance, the mutual insurers are enjoying quite a high market share, especially in housing insurance and liability, well, motor insurance, as you know, and direct insurance in this respect is describing essentially this kind of, motor and housing insurance sold by mutual insurance companies, which were said in France, or which are still called des mutuelles sans intermédiaire. That is to say, they directly distribute their own insurance contracts, while public limited company, les sociétés anonymes, rely on a network of agents. The yellow bars here, which are, by the way, not negligible in the case of non-life insurance in France, and as well as the brokers, of course, which are not affiliated or under contract with a specific company. Okay. So that's it. And the point is that, of course, markets which are dominated by brokers are much more are competitive in another sense than markets which are dominated, for instance, by direct underwriting or by bank and insurance, by banque assurance. Okay. Because the point with brokers is that you not necessarily know the company you're working with, but you know your intermediary. Okay. You know that in Britain there are many peculiarities. Until 2016, the contracts were not renewing automatically. That is to say, it was up to the policyholder to renew his own contract in order not to lose insurance coverage. While in France and in most continental Europe, the contract is rolled back at the end of the year if you don't move to stop it. Okay. So, in fact, distribution, well, now if we look at the peculiarities of a given market, clearly in the case of France, life is dominated by banque assurance, while non-life has an almost equal share for mutuals, which are in fact more effective in retail, housing, and motor insurance, and agents of large public limited companies, les grandes sociétés anonymes. And those agents, for instance, well, they have a significant market share in retail insurance, but also on corporate insurance as well. And brokers do exist. And there are brokers both for personal insurance, where April is the largest one, and for retail insurance, and for corporate insurance, where Grâce à Vous is the largest one. But there are more than 1,800 brokers in France, so that's a lot. And among them, there are the so-called retail brokers and wholesale brokers. Okay, so it's the ecosystem is quite complex, and mostly because of the distribution issue. Okay, well, in the UK, the brokers dominate the market so much that the number two company in terms of gross written premium, that is to say Prudential, decided more than 10 years ago to put his UK business on runoff and to completely redeploy in Asia, simply because Tidiane Thiam, who was the CEO of the firm at that time, ruled that there was no money to be made in UK, and he was somewhat right, because the expansion strategy in Asia went on really well in comparison with what the competitors did on the UK market. The only exception being, as I told you lately, Admiral Group, which developed an innovative comparative search engine based on the web. That is to say, only disruptive innovation can bring you some profit on the UK market if you're an insurance carrier, because the market is very competitive and dominated by brokers who eat up all the margins and even more. In Germany, the market is dominated by agents, that is to say, by those who have an exclusive contract with a given company. And of course, over the whole European Union, there's a peculiar EU directive for insurance distribution. That is to say, as I told you, that distribution is regulated separately from insurance. Okay, so you won't find much about this in handbooks on the microeconomics of insurance, but it's very important to understand how the sector works. And it's also a very good way to start working in this sector, because it is really a very quick course on how everything is functioning. So now that we've seen how insurance worked overall, maybe we could have a little look at reinsurance. That will probably end up our considerations on how to use insurance as a financial tool, as a tool of fiscal optimization, probably. But this was not the main design of reinsurance, because reinsurance was invented during the 19th century in Germany, by the time of the Industrial Revolution, because the values which were insured were too much for a single insurance group. So the idea when Königliche Rück was founded in 1846. So Königliche Rück is known as, the full name in German for reinsurance is Rückversicherung, because Versicherung is insurance and Rück means backward. Okay, so Königliche Rück is also known in French and in English as Cologne Re. And even the name Cologne is used in English. So in English we do say Cologne Re. While the German usually say Königliche Rück, but it's the same entity. Okay, so the idea was that single or usual insurance company did not have enough financial guarantees and financial surface to insure very large risk, such as industrial risk of the beginning of the Industrial Revolution. Because if you took into consideration a large steel mill, for instance, the possible risk involved in an industrial accident was so much that it was not possible to provide insurance for a single insurance company, because it was not possible to charge enough to be, to deliver a 99% confidence to pay back, or to pay for the claims in the end. So that the idea was to set up a second line of insurance which would provide a guarantee on extraordinary losses. Okay. Now, in fact, reinsurance evolved a little, because, the idea which was such, that is to say, when risks are too rare to be pooled, and hence to justify relying on the central limit theorem, which requires, as you know, at least 30 instances or 30 throws of the same random variable. So in fact, if you don't have 30 throws, then you cannot use the central limit theorem as an acceptable approximation. Then you must do something else. And that something else is simply resell part of your risk to someone who is able to compensate, because he is able to pool. Or the idea is that risk can be geographically correlated, and having a global actor, a global player, might be a clever way to disentangle that geographical correlation. Okay. So if we look at large risks, for instance, I think I already said you vaguely this, but this is the precise reference. Okay. So on March 18, 1976, a motorist stopped his vehicle in the middle of a railway crossing in Bar-le-Duc in eastern France. And, well, in fact, he had a breakdown. A freight train was coming, and the train hit the vehicle, derailed, and crashed into the railway bridge nearby, which collapsed. So the whole train and bridge fell into the canal from Marne to Rhine, and the canal itself was damaged, as was, and plus, of course, the circulation of barges was interrupted, and the circulation of trains as well. So that resulted into huge operational losses for weeks, which the train operator of the SNCF had to pay for. Okay, so overall, the insurance company for the SNCF had to pay 40 million francs of that time, which amount to approximately 9 million euros of today, as a compensation for the various parties involved. I mean, the SNCF, who lost the train, plus operation losses on the canal, plus rebuilding the bridge, etc. Okay, while in fact the driver only paid a penalty of 25 francs at the time. That is to say, only a handful of euros for 9 million. This is even better than Lotto, you can think. So large risks do exist. And the problem, of course, is that collecting enough out of 25 francs premium to pay back for 14 million francs is not very usual. So it might be clever to somewhat subcontract very large risks above a given threshold. Okay. Because of course, as you know, the central limit theorem only works when random variables are of the same magnitude. This is, well, you know that the classical central limit theorem by Laplace says that the random variables must be independent and identically distributed. This is of course too strong constraint in the real world. Therefore, we much more rely on the Lindeberg's condition, which states that no risk is so much larger than the other than it would derail the central limit theorem. So in this case, we're not, because when the risk is large enough, we're no longer under the Lindeberg condition. So in order to guarantee that the Lindeberg condition is working, what may be clever is to reinsure the losses above a given threshold, so that no risk will be so large that it endangers the convergence toward the normal law. I mean, for the claims and compensations. Okay. Now, another way where central limit theorem could be derailed would be if there is spatial correlation between risks. I mean spatial correlation because spatial correlation is the most common case of correlation in insurance. There can be another kind of insurance of correlation, which would be serial correlation. For instance, you do insure the liability of a given manufacturer for a given product. If the product is defective, of course, there will be many defects. That's it. But this leads to a very large risk, so please refer to the previous points. Now when talking about spatial correlation, spatial from space, okay, not spatial. I mean, if you look at natural catastrophes, of course, they happen over a designated place. Well, so far, we haven't seen a catastrophe happening to the whole Earth or to the whole universe. Well, this might happen with weather change, but this is the main reason why weather change cannot be insured overall. Okay, some aspects of weather change can be insured, albeit they are not completely random. But the whole stuff cannot, because nobody would pay for everybody. It is not possible to have an insurance scheme where everybody pays for everybody. This is not insurance. So, back to our natural catastrophes, there is a kind of geographical correlation, because when there's a flood, then the people who live in the valley where the flood happened are all in trouble. Okay, just see what happened in southeastern France 2 weeks ago, for instance. Okay, so usually correlated risk are difficult to insure, and for this reason, natural catastrophes in France benefit from a special regime, and they are insured, under under the protection of law and under the guidance of state. We will see this into a bit more detail in a while. Okay, but usually geographical correlation derails the independence assumption, hence it is not insurable, hence either you have to, the state has to design some provision, or you have to find an actor, a player, which being global by essence can somewhat diversify the risk, okay? Yeah, COVID as a world catastrophe is a good example. And the question whether we could insure COVID is a good question as well. The question being, what are you insuring exactly? But let me end up with this, and I'll be back to the COVID stuff in a while. So reinsurance companies, as they are global by essence, in fact, they could provide some geographical diversification, because if you think of, for instance, insurance against hurricanes in France, it won't work, because usually when a hurricane happens in France, it will, half or a quarter of the country will be hit. Hence, it's not enough to diversify. But if there is a global player who can team up insurance risks, hurricane risk all over the world, then it might work. So this is the rationale for reinsurance. Now, if we look at if we look at insuring COVID, so you got it, Oussama. The main point with COVID is, of course, operational loss insurance. Okay, les assurances de perte opérationnelle. On dit perte d'activité aussi en français. Well, this has been quite controversial since the beginning of the pandemics, because the French Insurance Federation is saying that no, we don't have any liabilities in this field, because, pandemics is an act of God, somewhat. By act of God, we mean no one is responsible, except maybe, the guy overhead, but he doesn't claim liability, and in fact, he's not liable. And therefore, we shouldn't pay, because since no one is responsible, no one is liable, not even the insurance company. And on the other hand, some insurers, such as les assurances du crédit mutuel, decided to pay somewhat. But this is more a matter of marketing than a real issue. Because in the end, the main insurer for everything at the moment is the European Central Bank. I mean, the government has expended money for furlough schemes, that is to say, le chômage partiel. And of course, that money was not paid by the taxpayer for now. It was paid by borrowing from banks, which bought bonds from the states, and those bonds were rebought by the European Central Bank from the commercial banks, because the European Central Bank cannot directly buy bonds. And so, in fact, the funny thing is that the European Central Bank lent money to the banks so that the banks can buy the bonds from the state, and then the European Central Bank rebought the bonds from the bank, and the banks repaid the money to the European Central Bank. And in the end, the government was provided with money from the central bank and could not insure, of course, but provide the corporations with some relief money in order to avoid massive failures and bankruptcies, of course. Now, there are others. There are other issues with pandemics, of course, and probably there is a way an insurance scheme could be organized. I don't know whether it's the place, since I don't have slides, so you won't remind the detail. But the idea is that for very large risks, usually what is done is that there is a multi-layer insurance system. That is to say, on first level, insurers are selling contracts, but they are not taking the full risk for themselves. They are reinsuring somewhat, the excess loss above a given threshold, as we will see. And that excess loss is usually resold to reinsurance companies, but reinsurance company might as well resold the excess loss, which might be taken by some special reinsurance companies, such as, for instance, the Caisse Centrale de Réassurance in France, which is provided with a state guarantee. But if you look at what happened during the pandemic that time, basically we relied on state guarantee, which was in last resort provided by the European Central Bank. Okay. But let's go back to classical insurance. I mean, people paying for a contract. And how can I close that chat window, which is in the middle of the screen for me? I don't know whether you see it. That's it. So let's go back to reinsurance by looking at the largest reinsurers. So the largest, but in terms of gross written premiums, is Swiss Re. The second largest is Munich Re, but in fact it depends from one year to another. Okay, and as you know, those reinsurance companies originate in the German-speaking world, and of course Swiss Re comes from a German-speaking Swiss city, which is Zurich. Okay, so then there is Hanover Re, which originates from Hanover in northern Germany, while Munich originates in southern Germany, as you know. And then there's the Lloyd's, which is in fact a bit peculiar because the Lloyd's is not operating entirely on itself. As you know, the Lloyd's is both an insurance company and a broker, which is providing brokerage services between so-called names who are providing guarantees on their own wealth on the one hand, and of course policyholders who are looking for a guarantee. Okay, so Lloyd's is not just a carrier; it's also it's mainly a distributor, of course. Then the largest French reinsurance company, which is SCOR, and SCOR, as you know, SE means Societas Europea, so it's a company incorporated under a European regime, which makes it easier to merge with other European companies. And then comes Berkshire Hathaway, and which is the company founded by Warren Buffett. This is not the full, 26 billion is not the full turnover of Berkshire Hathaway, because Berkshire Hathaway is not just providing reinsurance services, it's also providing insurance services and life insurance services and pension services, etc. So the overall turnover is far larger, but this is the reinsurance part, which is still large. And then comes the first Chinese reinsurer, okay. And then come many guys, but not that many, because the reinsurance sector is very concentrated for obvious reason, which is that you're looking for the kind of diversification and pooling of risk, which you cannot achieve in a smaller structure. Hence, by essence, the reinsurance market was concentrated from the beginning and remains at a high level of concentration. That is to say, I think the 10 largest world players do more than 70% of the global turnover, which is quite exceptional in any industry. So now, how does it work? In fact, there are two basic methods. Either proportional or non-proportional reinsurance, which is not very clear. Or you can say as well quota share to designate the proportional insurance treaty, because in the field of reinsurance we don't write contracts, we write treaties. So proportional treaties are usually referred to as quota share treaties, and non-proportional treaties are usually, in fact, insuring the amount above a given threshold, and we call this stop loss, or because it gives a stop to the loss. And usually the stop loss is not provided for a given risk, but for a portfolio of contracts. Hence, we talk about aggregate stop-loss treaties. Okay. So the criterion for choosing between a quota share insurance or reinsurance on the one hand and a stop-loss treaty on the other hand is a cost versus benefit analysis. So this is what we are going to do by looking into a small model, which is in fact derived from Borch. Karl Borch was a Norwegian actuary who wrote many microeconomics in the field of insurance. So in 1960s, 60 years ago, he wrote a paper entitled Optimal Reinsurance Treaty, which describes both quota share and aggregate stop-loss treaties. Okay, so the assumption of the model, the very simple model which we'll follow, are simply that we figure a portfolio of 10,000 policyholders. And every such policyholder is a Bernoulli variable with a 1% chance of loss and the amount of loss is 1 money unit. So it's the simplest model I found. The compensation to be paid, C for compensation, of course, is a binomial variable, and N, the number of throws, is 10,000, and P, the probability of success, that is of loss, is 1%. Okay. So the mathematical expectation of C is number of throws N multiplied by probability of loss P, and P is 10,000 multiplied by 1%. So on average, there are 100 losses. Okay, so on average, 100 policyholders experience a loss, which must be compensated. Hence, the value of losses is 100 as well. Then the variance of the number of losses is for a binomial variable is the expectation multiplied by 1 minus the probability of loss. That is to say, 1 minus P is 0.99. Hence, the variance is 100 multiplied by 0.99, so 99. So it's almost 10 squared, okay, for the sake of computation. But we won't go into computing the standard error, but whatever. So the pure premium for the policyholder here is only a cent, because there is a 1% probability of a 1 loss. So the expectation for the given customer, the given customer exposed to risk, so for any policyholder is 1%. Okay. Now let's see how the reinsurance treaties work for the reinsurance companies and the insurance companies as well. The insurance company as well who is buying the treaty. Okay. So if we look at the quota share treaty, en français on va dire un traité en quote-part. Okay. So the quota share treaty, for instance, is that the reinsurer pays 5% of every claim. So if we compute the pure reinsurance premium, that is to say the mathematical expectation which the insurer is supposed to pay, it's only 5% of the pure insurance premium. That is to say the mathematical expectation of what the insurer is supposed to pay for. Okay. So 5% of 100 is 5. But now if we look at the variance for the insurer is of course 90. The variance is the variance of 95% of C. Since the variance is a quadratic form, the variance of 0.95 multiplied by C is 0.95 squared multiplied by the variance of C. That's written here. And so 0.95 squared is somewhere close to 90%. Hence, overall, the remaining variance for the insurer is 89, in comparison with 99, which was the variance when the insurer hold the whole risk for himself. So the variance has been reduced by 10% by reselling 5% of the risk. So that may look interesting, but of course it's simply the consequence of the variance being a quadratic form, because of course 1.05 squared is 1.10, and that's it. Now for the reinsurer, the variance which the reinsurer acquires is in fact the difference between the variance on the contract, the overall variance, and the variance which the insurer kept. That is to say, the insurer bought 10% of the 10 units of variance. Okay. So for the insurer, the bargain with the quota share treaty is that you pay 5% in order to get relief of 10% of the variance. This may look interesting, but it's far less interesting than the stop-loss aggregate treaty, which we would call in French un traité en excès de perte. And in my opinion, traité en excès de perte is far clearer, okay? Because it says that basically what you're ceding, what you're selling, is the loss above a given threshold. Okay. For instance, assume that the insurer is only willing to pay for the mathematical expectation of risk. That is to say, he will be paying up to 100. If the losses are below that mathematical expectation, then fine, I will pay less. But if on a given year the losses are above that amount, then I'm signing a treaty with a reinsurer so that the reinsurer will take full liability for everything above 100. So if we, well, under the assumption of independence, which, by the way, might not be true for the insurer, but might be true for the reinsurer once the reinsurer acquires the, the residual risk or the risk above the threshold, since the reinsurer might have a better portfolio to diversify risks. And since the expectation of payment is 100 and the variance is 99, what we can write is that the premium which the insurer should pay should be equal, the pure premium should be equal to the mathematical expectation of risk for the reinsurer. So what is this mathematical expectation? This mathematical expectation is simply the expectation of x given that x is above 100. Okay, so that, well, and I should say that this should be divided by the probability of, or multiplied by the probability of the risk being above, by x being above 100, but so the expectation expression is not correct, but the integral is. So where does the integral come from? The integral simply comes from the, the density of the normal variable, which is an approximation of the binomial variable, because of course it's far easier to compute with the normal than with the binomial. Okay, so you recognize the density, which is 1 divided by the square root divided by square of 2 pi. And the rest of the density is exponential minus 1/2 x minus expectation divided by standard error squared. Plus there is an x term which is necessary to compute the expectation. Okay, the x term is here. Okay, of course I'm not doing the computation because that would be that would make us lose too much time. Plus, in fact, I see no way to implement this then in an exam. I'm not saying that I won't ask you to compute that kind of expectation. I'm just telling that I'm not going to ask you to compute this with a normal distribution, or maybe not without doing some prior exercise. So when we compute the expectation there, we find 4. That is to say, the contract is less expensive than having a 5% quota share on every risk. But the idea there is that you're completely relieved from the risk of experiencing claims to be above the mathematical expectation. So by paying 20% less, you get a coverage which on average might be 0, but some year might be much more. In order to investigate this, we should compute the variance of the losses, and well, the variance of the losses is of course the expectation of losses, of square losses minus the square of the expected losses. Okay, so we can compute this by using the same formula, but instead of computing the expectation above 100, we compute the expectation of the square losses. Okay, and we subtract then the squared expectation. Okay, so I don't know why it would have been simpler, in fact, to subtract pi squared, but whatever. Maybe I should change a bit these slides. Whatever. In fact, the good thing here is that the variance there, when you compute it correctly, is 34. That is to say that the reinsurer stays with 65. The reinsurer takes, in fact, almost two-thirds of the overall risk, while the policyholders only keeps 1/3 of the risk. So for 20% less than the quota share, you got a far better coverage in terms of variance. Therefore, reinsurance can help you much getting rid of extreme risks as long as you correctly design the contract. Because of course, what is absolutely crucial here is the insurance threshold, okay, above which the amount is taken by the reinsurer. I must add here that the idea of having the average risk, the average loss as a threshold is completely unrealistic, because it would be too expensive. So the point is whether you should take a rather large threshold at a low cost, but at the risk of having large losses, or a lower threshold, which might relieve you from recurring losses, but at a higher cost. This is, this bargain or this arbitrage is exactly what is called risk appetite. And it must be added that, in fact, reinsurance is not the only way to transfer those large risks. Or shall I say, in fact, reinsurers themselves, they don't use only premiums paid by insurers to guarantee the risk they take in their balance sheet. They also use what is called alternative risk transfers, and usually you will see the acronym ART for alternative risk transfers. What are alternative risk transfers? Oh, basically they are securitized and structured insurance risks. That is, by securitized, I mean, you probably know this from the course in economics of banking last week, but the idea is that you build a vehicle where you take or even maybe you can directly issue bonds. For instance, if you take catastrophe bonds, okay, cat bonds, which we call des obligations catastrophes in French. The idea of cat bonds is that they pay quite a high interest rate, but they would be voided if a trigger event happens. For instance, assume you're a Japanese insurance company and you're offering some insurance in case of earthquake in Japan. Of course, a minor earthquake is insurable, but a large is not. Hence, what would you do in order to make this guarantee possible? You issue those cat bonds, and the contract for the cat bonds basically says that the $5 billion US dollar issuance would be completely voided if the amount of damage which is done by an earthquake between 2020 and 2025 for a given earthquake, of course, is above 5 billion, or if the amount of damage resulting for a given number of earthquakes during the same time limit is above 5 billion. Of course, issuing such a bond about earthquake in Japan would yield a very high interest rate, because unfortunately earthquakes are sure to happen in Japan, the only question being when. Okay, so you can issue catastrophe bonds for less risky risks, shall I say, or less probable risks, but basically there is an element of wager in cat bond, where you bargain a very high rate of return, especially now that interest risk, now that yield on AAA corporate securities is as low as 1 or 2%, you can get 7% from a cat bond, but at the risk of not getting your money back. So one typical clause of cat bond is that you designate a portfolio of insurance contracts, and you say that in case the total amount of loss resulting from that portfolio is above 2 billion, for instance, US dollars, during the year 2021, the bonds will not be paid back. So there's a trigger event. The trigger event has a meaning in terms of insurance liabilities, and the idea is that the bondholders, the investors who bought the bonds, would eventually pay for the risk in case the trigger event happens. The trigger events usually being the losses on a portfolio being above a given threshold. So most usually catastrophe bonds are a form of securitization of a stop loss contract. That's it. Well, there are other forms of ART, either because the trigger events are more complex, or because, in fact, the securities themselves are somewhat tranched, structured. So I won't go into the details, but the idea is that, in fact, that kind of securitization of risk began with the insurance company not very long after the banks have started to securitize loans, for instance. So there have been instruments developing from the 1990s. They do exist, and I won't be focusing on this because this is not central to insurance, and it looks very much like structured finance. Okay. But the idea simply here is to remember that insurance, reinsurance, is designed to provide compliance with the assumption of the central limit theorem when that compliance is not provided because either there are extreme losses which derail the Lindeberg condition, or there is correlation, and correlation, of course, is incompatible with the assumption of the central limit theorem. So you can remove correlation by going to larger mutuality, a larger pool of risk. And then the reinsurers themselves, they could either rely on state-backed reinsurers, such as la Caisse Centrale de Réassurance, or alternative risk transfers to transfer part of their risks to the market in order to diversify even more. That's it. So before we move to the next section, which will be concerned with non-life insurance, maybe we could have a look at the insurance contract in itself, just to make it sure that we know what we're talking about. Okay. So an insurance contract states out the premium to be paid and the list of events whose occurrence would trigger compensation. We call this guarantee. Okay. The contract may also specify the type of insurance, okay? That is to say, exclusion from cover, specific events which are not covered by an insurance policy. And there is a difference, a major difference between the two types of contracts. Some list the guarantees and some list the exclusions. Okay, it is usually said that the US way of underwriting insurance is by stating the exclusions, while the British way is by stating the guarantees. But at any rate, you must, before you sign an insurance contract, either as a policyholder, as a prospect policyholder, or as an insurance company, you must understand how the insurance court will rule about your insurance contract. You know this. You must understand whether the court will look at the exclusions or at the guarantees, because in some case, the guarantees are implicit as long as you did not exclude them, while in some cases, nothing is included if it's not written on the contract. The contract may also state the obligations of the policyholder in terms of risk prevention, as well as deadlines for reporting claims, and the terms where premium payments must be made. Because if you don't pay your premium at a time, you may lose your guarantee, while still being liable to pay the premium. Okay. Well, this is especially important. Well, maybe not in the case of retail. Well, in the case of retail insurance, of course, that paying your premium is required. But I mean, the obligations of the insured in terms of risk prevention this is really interesting, because since insurers are expert in risk management, they can somewhat help reducing the overall damage resulting from risk in a society. And if insurers were only to pay for a compensation, they would not contribute to reducing the risk. They would only contribute to reducing the consequences of risk. While the interest of having insurers in a given society, in a given jurisdiction, is that they will since they are reluctant to pay, of course, but also since they know how the risk works, they can provide very important advice and directions as to how to diminish the risk, both for the policyholder, and this is especially important in the field of industrial risk, for instance, where insurers act really as consultants for reducing the risk of industrial operations, for instance. or at the level of society as a whole, because, for instance, motor insurers are pretty much interested in the way the roads, in road safety in general, that is to say. So they will probably lobby, to have more safety belts and safer safety belts and technical review of the vehicles on a regular basis, etc. And this would reduce the overall damage and risk in the society. And this is a welfare gain for everybody. That's it. Because the point is that this is interesting here, because there is a contradiction between the individual level of the individual perception of the phenomenon and the global perception. That is to say, you won't pay for your car to be safer because it would be too expensive to pay for the development of safety devices. But if the insurers they do lobby for a given safety equipment to be made mandatory, then the cost of having it in vehicles will be lowered, and so everybody can afford the technology that would be only reserved to an elite, if not. That is to say, in fact, in many cases, insurance allows for the democratization of a risk protective device. And this is something people forget. But since since they team up risk, they can think of global expenses which you cannot afford at your individual level. That's it. So the contract states as well the insurance obligation with regard to payment periods and in the event of a compensation to be paid to the policyholder. Plus, certain conditions of the contract may be subsequently amended or supplemented in the form of amendment to the contract, which is des additions contrat. Okay, but basically, the obligations and benefits of the parties are stated in the contract, and of course, the most significant in this respect, or the most interesting for us, is the premium, simply because the premium measures the actual, the actual expected loss. Okay, so we talk about three types of premium: the commercial premium, the pure premium, and we'll talk in a short while about the inventory premium. Okay, so the commercial premium is what you pay. It's fully loaded. And in fact, it comprises marketing costs and administrative costs, etc. Okay, management costs, whatever, cost of capital for paying the shareholders, etc. In fact, what is determined first is the pure premium. The pure premium being the mathematical expectation of the guarantees. Okay. So the pure premium is what enables the insurer to meet the average claims before taking into account any extra cost, which is not related to meeting your claims. That pure premium is simply the mathematical expectation of the insurer's commitment. So to determine it, the point for the insurer is to make a list of the events which are covered by the contract, and then price each of those risks by computing giving the distribution of losses and computing the mathematical expectation of that distribution. And then you sum it up and then you got it. That kind of pricing and an estimation of the distribution of losses is performed by the company's actuaries using statistical methods. And of course, those statistical methods derive from the payment history of the company. And there's a last premium concept, which is intermediary between the pure premium, which is mathematical expectation of losses, and the commercial premium, which is what you pay, which is the inventory premium. And the inventory premium, in fact, features the management cost, but not the marketing costs. Okay, now that you signed the contract and paid the premium, you're insured, and maybe we can see what you're good for. So let's look first at non-life insurance. And by non-life insurance, we mean, well, I've been talking about this quite quickly last time, but I may go in, maybe not into more detail, but I will give some slides with the written text. Okay, so liability insurance, motor insurance, housing insurance, which usually comes along with so-called multi-risk insurance. We'll see why. Health insurance. Then there are two kinds. Well, insurance. These insurance classes are included in non-life, such personal accident insurance, la garantie des accidents de la vie, and nursing care insurance, l'assurance dépendance. I won't be talking about them because it's specialty insurance. And well, I know nursing care insurance is an insurance dream because we all know that elderly people will grow faster than any segment of the population in the coming years. Hence, for the insurance, it looks very much like a jackpot. But for the same reason as health insurance, it is so much structured by the law that the idea is simple to understand. Right? There is a trigger event, and then you can price the contract, which relies on the trigger event, and then on a distribution of losses, and that's it. But all of this is completely dependent on what the law says. Okay, so I won't be going into much detail. While in the case of liability insurance, motor insurance, and housing insurance, well, first, it's a larger part of the insurance market. Okay, because the whole property and liability sector in France is around 60 billion of premia written or underwritten in 2019. Okay, it will be probably less in 2020 because of what you know, and moreover, as you have seen, some insurers have decided to pay back some discounts to their customers. For instance, Maif has paid back part of the motor insurance premium simply because people drove far less than on a usual year because of the pandemic. Well, so probably the turnover next year for 2020 will not be as high as 2019 for property casualty, but from this 60 billion, more than a third comes from motor insurance, then more than a sixth come from house insurance, and then an important remaining part comes from professional liability insurance and agricultural insurance. Plus, well, so other insurance such as NatCat and personal insurance, etc., are only a fifth of the whole. So I'm not going into much detail about this. Well, what is liability insurance? In fact, liability insurance is a contract that guarantees the monetary compensation for the consequence incurred by the insured when he or she causes material or physical damage to a third party. Okay, that is to say, the liability insurance will be paying. Well, we'll see how the payment scheme works because it's not that simple. But basically, you are liable, and you must pay something to someone, and in fact, that money will be paid eventually by the insurer. Okay, whether the damage are your willful act or are a result of negligence or imprudence. Okay? So this liability comes from the Code Civil, especially Article 1382, which states that any act of man which causes damage to another person obliges the person through whose fault it occurred to compensate for it. Okay, so it must be added that liability is not limited to the acts of individuals themselves, but extends also, this is completely Roman law, in fact, it also extends to their belongings, that is to say your house. If your house collapses on someone, then you're liable because this is your house. And even not your house as a owner, but your house as you're a tenant, you're inviting people to your place, not after the curfew, of course, and then the house collapses, then of course the families of the people who were crushed by the house can sue you And then you can sue the landlord because you think that the house was poorly maintained. But first, things happened at your place. Same happens for your car, for your luggage, for your whatever, okay? So you're responsible for your belongings, for your animals, of course. If your dog bites someone, then you're liable. And even dependent persons, such as minor children, and this is completely Roman law as well, your domestic employees. That is to say, if someone is working at your house, for instance, your cook, if your cook sets the place on fire, then you are liable, not the cook. Okay? So take care of your cook, please. And this comes from the same article of the Civil Code. One is liable not only for damage caused by one's own action, but also for damage caused by the action of persons for whom one is liable or things in one's care. So the funny thing here is that this has not changed since the Roman times. Oh, yeah, no, I should have said it has changed much, especially because during the Middle Age, there was a question whether animals were liable, okay? But themselves. So whether the animals had a legal liability for things. And by the way, the question might be raised as well. Know that some people advocating for anti-specism. If you think that every animal species is equal, then of course the horses must pay for the damage they do. Okay, for the losses people incur because of them. So from the point of view of insurance, horses are not equal to men simply because men are liable and horses are not. Okay, and this doctrine dates back to the Roman Republic. By the way, civil liability, as I told you, civil in French means not contradicting the law and only relevant to money. And of course, civil liability does not mean criminal liability. Criminal liability is what you must pay for when you break the law. And of course, criminal liability may not be insured. Okay, albeit to some extent, the civil liability, that is to say, what happens to other because of your criminal behavior, may be insured. And by the way, what we see is that criminal offense may lead to compensation for your liability. I mean, to money compensation, that is to say, to civil liability. For instance, Kerviel, the rogue trader who stole money from Société Générale, or in fact, who hid his toxic trading from Société Générale, he was sentenced in the end to pay almost 5 billion euros of losses, which he willfully caused. So there is the criminal responsibility, the criminal liability on the one hand, so he went to prison, and on the other hand, there is a civil liability, which is to say he has to pay. So when you have criminal liability, usually there is also compensation for the victims. But on the other hand, the reverse is not true. That is to say, for instance, if your dog bites someone, then you're not liable unless your dog is a forbidden race. Of course, if you do own a pit bull while it's forbidden, your criminal liability might be engaged as well, and then you might be fined or go to prison. But if your dog is a normal dog, then you have to pay for the compensation of the victim, of course, or your insurer has to pay, but you won't go to prison, at least for now. Okay, so everyone is liable for the damage he caused, not only by his own act, but also by his negligence or imprudence. That's it. It's still Roman law. So this is the point of view of the liability of the one who makes the losses. But the question now is, how can the victim place a valid claim? And in fact, for the claim to be valid, the victim must prove that there was a fault. Not necessarily willful, of course, but fault might result from negligence, from imprudence, from recklessness, from inattention, from whatever. Then there is a damage, which can be measured, okay, either physical damage or Physical damage, on va dire des dommages corporels en français. Okay. Material damage, c'est des dommages matériels, ça veut dire pas à la personne, donc pas corporel. Or moral damage. By moral damage, we mean they are not physical, but they are real. Okay. By moral damage, the point is not just that you killed my dream. This is moral damage, but you cannot get a compensation for it. But if you need to get, if you need to go to a psychologist twice a week, then this is moral damage that can be paid for. That must be compensated because there is a cost, actually, okay? A measurable cost. But the point is not just a fault and a damage. You must prove that there is a causal link between the fault on the one hand and the damage which you incurred on the other hand, and in which case your claim is valid. How does the payment scheme work? This is not obvious. What is obvious is that the victim, which is the claimant in this case, the victim has demonstrated that a liable person is responsible for a loss to her, to the claimant. Okay. So what the claimant must do is call his or write to his insurers or her insurer in order to get compensated, and the claimant insurer will compensate the claimant. That's it. Albeit the liable person is not, and the liable insurer and the payer of last resort is not the claimant insurers. Okay, the claimant insurer is just a medium. It's just an intermediary here. And the point is just that it's easier for you to call your insurer, which you know, than to find the insurer of the liable person. Okay, so this is the basic scheme. You call your insurer compensates you, and then your insurer makes contact with the liable person's insurer in order to get refunded. Okay. There are special cases where, in fact, the liable person will pay. For instance, if the loss is actually excluded from the contract. If the loss is actually excluded from the contract, and usual exclusions are for willful offense. You see, when, for instance, well, that's the point. If you kill someone, the insurance company of the if you kill someone, not as part of your business, but on a private venture, if I may say, and then the family of the claimant goes to the insurer gives them a compensation, then the insurer turns back to your own insurer. You have a liability insurance, so that your insurer is forced to pay something, but they will get the refund from you, because killing willfully people is not insured. So they pay so that someone will pay for the victims, but in the end you're supposed to pay. And if you cannot pay, then you'll be bankrupt. But whatever, it is the duty of your own insurance company to get the money from you. Okay. And what can happen as well is that you're not insured. If you are not insured, then what happens is that the claimant insurer will recover the money from you. Well, this might be tricky because usually people are not rich enough to pay, but at least they will try. The point with being insured is that even if your insurance does not cover does not provide you direct coverage, at least your insurance company will act as an intermediary between you, your claim as a victim, and the person who are liable for what happened to you. And in this respect, your insurance company can provide you with the money, with the compensation, even when the liable person is insolvent. And so that's a good reason to buy insurance, especially compulsory insurance. Okay. Well, still, liability insurance has some limitations, okay? So it does not work in case the damage is caused intentionally, especially when the law is intentionally broken. It also doesn't work if the damaged goods belong to the insured. This is in order to prevent moral hazard, okay? Because I do have a bill for $10,000 for a watch which I bought last year, and I damaged the watch because I threw it on the toilet, and I cannot recover it. But please pay me the $10,000 bill. This doesn't work. You cannot take advantage of your own liability to pay for your items, nor for goods that do belong to your close relatives or people living with you, such as your domestic employee, if you have some. Okay. And the last limitation is that the guarantee is strictly private, which is to say that liability which arises from your professional activity must be separately insured by a professional liability insurance. Okay, and we have seen last week that there were many professions in France, more than 200, which are eligible to that kind of compulsory professional insurance. And the amount which is paid as premium for this professional liability insurance is very variable from one profession or from one specialty to the other. For instance, if we take a physician, a general practitioner, among physicians, if we think of a general practitioner, then a general practitioner usually pays less than 1,000 euros per year as professional insurance. Okay, un généraliste paye moins de 1 000 euros d'assurance responsabilité civile professionnelle. While a surgeon or an anesthetist usually pays in excess of 30,000 euros of insurance per year, not per month, but still per year. So that's really a budget. Okay, and of course, well, this is one reason why those guys are paid that much. This is because they have a huge professional insurance to pay for, of course. So enough for the liability insurance, and let's have a look at the motor insurance now. So if we look at motor insurance, we know that it is mandatory in France since 1958, so 30 years later than in most civilized countries. Since it is mandatory, if you get caught without insurance, on the first time you will be fined, and you will get a suspension from your driving license, which can be as long as 3 years. But on the first time, you probably won't get the full 3 years suspension. But if you get caught a second time, you will probably go to prison. And the fine is quite large. It's more than, I think the first fine is 500 euros, which is a basic fine. Then the court may raise something above this level, plus the suspension of the driving license, okay, plus the prison in case of renewed offense. So the point with motor insurance is not what happens to people who don't buy it. The point is how to provide insurance, okay? So the premium, of course, will depend on the list of guarantees which is offered by the contract, on the characteristics of the driver, on the characteristics of the vehicle, and eventually, in the case of France only, on the claim history through the bonus-malus system. So let's review all these elements. So first, if we look at the guarantees, most motor insurance schemes or most insurance company will offer at least 3 motor insurance contracts. First, there is a basic motor insurance contract which features only liability, plus a legal protection scheme which is not very expensive in fact, and which in French is called défense recours. What means défense recours? Défense is in case you are sued because of what you did as a driver, then you are provided with a legal protection, that is to say the insurer will pay for your lawyer. And recours is, the converse. You are the victim of a car crash and you want to ask for something, some compensation, then the insurance will provide you with some legal protection as well. So this is the basic package. You won't find an insurance with less than this, simply because the liability is mandatory, and the legal insurance, which is quite somewhat related to the to the implementation of this liability. Then there are intermediate insurance schemes which usually feature vehicle assistance in case your vehicle breaks down in the middle of the road. Then a towing car or towing truck will come and tow your vehicle to the next garage, and then you will be provided some services to go back home. Okay. In case you want the mechanical breakdown itself to be treated and the car to be fixed, or better, in case you want to be lent a car while your car is being fixed, you have to subscribe a mechanical breakdown insurance, which is included in full coverage package, but not in insurance. Usually not in in intermediate insurance packages. Then a guarantee which is typical of intermediate schemes is personal insurance for the driver. Because what happens in case you crash your car is that your liability insurance will compensate for anybody that you kill or wound or whatever, but not for you. So, well, in case you die, this might not be an issue, but it might be an issue for those who survive. And in case you get injured or disabled, of course, you won't get any compensation, since if you have only your liability insurance, because it's the same thing we just noted as a limit to the liability insurance, which is that liability insurance does not pay for the damage you or your relative or your things or whatever incur. Okay. Then you can also insure your car from being stolen or burnt, or the glasses from the windscreen and windows of the car from being broken. This is a specific guarantee. Then there can be weather insurance against whatever, because for instance, hail is not part of the usual insurance. In order to get insurance against hail, you have to subscribe a weather contract. Hail, c'est la grêle, hein? Okay, and hail can do much damage to the cars. On the 4th of July 2019, in my hometown in southern Charente, we had a very strong bout of hail. And when I say very strong, there is one town where every single roof was destroyed by the hail. And I've seen damage to cars which you probably had never seen. Even the windscreen, the hail was so strong that the windscreens were torn apart and they fell under the weight of hail. So this can be damaging, but you can find a garage as well. Okay. So eventually, what you can add is an all accidental losses insurance, which doesn't exist, in fact, in UK contracts. The point with all accidental losses is simply that, in case your car has, in case there is an accident, and you cannot find who is liable for the accident. Typically, you park your car and someone rips your car or breaks it or whatever, or crushes it, and of course, the guy who does this, he doesn't leave a letter to explain and to take full responsibility of his acts. So you're left with your damaged car and no one to pay for. This is what is covered by all accidental losses. But usually this is quite expensive and goes with a deductible, une franchise. Okay. So when we say motor insurance, in fact, we may include many guarantees, and of course, only one is strictly mandatory, that is liability insurance. And of course, the more guarantees you add, the more pricey the insurance will be. That's it. Then, other elements which are taken into account to compute the premium, that is to say, to price the insurance, are usually the driver's age, because it is well known that the younger you are, the more dangerous you are, especially young men. So policyholder drivers between 18 and 20, usually they have 2.5 times as much or more accidents than 30 years drivers. But this is an average between male and female drivers, and in fact the probability for young male to have accident is even higher. It's closer to 4th time more for young men. Okay. Then the driver's experience also might be a problem, albeit this is quite difficult to distinguish from age in itself. But usually there's a penalty for the first year, or not always the first year, but some of the first years in insurance. In France, that penalty is limited by the law to 100%. That is to say, you cannot do more than double the insurance premium on the first year. Then there might be also some elements of the track record of the driver. For instance, if you experienced a penalty because you broke the law and that felony resulted into an accident, basically if you were drunk or smoked pot or whatever. Or also, this might be true for misdemeanors, infringement of the driving code, such as overtaking when it's forbidden, or driving above speed limit or whatever. Then you can be given a penalty for 3 years, and that penalty might be 150%. That is to say, you pay 2.5 times the basic premium because of this, track record. So this is related to your own, to the experience or to the characteristic of the driver. Now there can be characteristics of the vehicle, and of course one of the characteristics is the power of the vehicle, because the more powerful the vehicle, the more damage you can cause to others. So this extends to the civil liability, to the liability insurance, and to the most basic insurance. Then, now, if we think of damage insurance that you can write for your own vehicle, the cost of the vehicle will be taken into account, because of course, if you insure a vehicle which is worth nothing, there will be nothing to pay. Well, if you have a gold-plated Rolls-Royce, it might be a bit more expensive if you crash your car and expect some compensation. So this should be taken into account in the pricing. Then the private or professional use makes some difference. Well, in fact, it made some difference, especially when it was difficult to measure the annual mileage, which was done with the car. But now that pay-as-you-drive schemes are implemented, it doesn't make much sense to distinguish between private and professional use, except that since professional use can be taken, is tax exempt. I mean, it's taken from your company's money. Then usually it's more expensive, and it's specified in the contract that private insurance contract does not cover professional risks. So it's an exclusion, so you must pay an additional something. That's it. But what I wanted to say is that in the past, the reason basically was that people who had a private car insurance, they drove, say, 5,000 kilometers per year, while people who had a professional use of their vehicle, they drove 5 or 10 or 20 times as much. Therefore, they had to pay more. But now that there are pay-as-you-drive, it might not be entirely justified, except that since there is an exclusion, you must pay an additional contract, because if you don't do this, you will be excluded, hence you won't get any compensation. So now there are pay-as-you-drive schemes which rely on your car having a GPS or whatever device to identify the kilometer you're driving. And so this is supposed to, well, the reason why, of course, these schemes do exist is that you're supposed to have a more or less constant rate of accidents. Hence, the more you drive, the more you have accidents. And of course, having a pay-as-you-drive insurance might be more interesting and appealing to drivers who do not drive much. That is to say, women and elderly drivers. In fact, contracts still do exist which offer limited guarantee for a limited mileage per year without paying for the pay-as-you-drive device. because for the pay-as-you-drive contract, you must have some kind of measurement instrument. So, for instance, they are low mileage contracts, but whatever. Eventually, there is a difference which might be taken into account in the geographical area, because it's not the same, driving in Cantal where nobody drives, where there are not much risks, because not that the roads are especially safe, but the traffic is not very dense. While if you're in Paris, the traffic is more dense, especially if you're going on the peripheric, etc. And as well, there might be a surcharge if you do not own or rent a garage, especially if you do have some damage insurance, because of course your car is more at risk when it sleeps in the street. Okay, so overall, there are many factors who may influence the premium, and the last one being the way you drive, because now there are insurance schemes which take into account the way you drive, and they are called pay-as-you-drive. No, not pay-as-you-drive, but pay how you drive. Okay, detecting the way you're driving can be achieved with a regular smartphone, because as you probably know, these features both a GPS, which helps locate the telephone, hence give an approximation for speed, and are also accelerometers that can measure both linear and lateral acceleration, which give a pretty good approximation of the way the driver drives. Because with linear acceleration, we have an idea of whether he accelerates and brakes strongly, and with lateral acceleration, we have an idea of the speed in curves. So overall, we can measure the aggressiveness of driving and the precision of driving. Okay, and there is an American company which is providing a pay-how-you-drive contract, and the name of the company is Root. I studied it not very extensively, but just to show that actually the business model is not working. Dans la revue risque, j'avais fait un papier sur les fintech en assurance auto et habitation en particulier. Donc il y a le lien si vous voulez voir. Well, that's it. So in fact, the most interesting part of motor insurance is not, in fact, the detail of the contract, but its segmentation, because segmentation was more or less maybe not invented, but it played a very active role in motor insurance, especially in France in the 1960s. So in order to understand what segmentation means, just let us consider a market with two insurers, okay, insurer 1 and insurer 2, and in the beginning both sell an identical contract with the same guarantees at 100. And then insurer number 1 perceives that there is a class of less risky drivers, and insurer number 1 devises or designs a test which makes it possible to segregate or to recognize better drivers. So insurer number 1 offers a bargain contract at only 80 for those drivers who pass the test. And those who do not meet the conditions, who do not pass the test, they must pay more, 120, because they are bad risks. Okay. So what happened, of course, is that this will attract the best drivers from the other insurer, while the worst drivers from the first insurer, they will be deterred by paying 120, so they will go to the second insurer. And so if the second insurer doesn't react, he will attract only bad drivers, which, by the way, cannot be insured profitably for 100, while insurer number 1 will attract only good risks, and he is said to skim the market. Okay, on dit qu'il fait de l'écrémage, ou qu'il écrème le marché. And the image, the metaphor behind this is that, probably you know this, of course, but when you take the milk from the cow, then after some time, the fattest part, which is called the cream, will rise through the milk and will stay. It will be separated. Will stay on the top of the milk, and of course, it's the best part, the most savory part of the milk. And when we say we skim the milk, it simply means we take the best part of it. Okay. So segmentation helps to take the not only the best part, but to control your risk by, in fact, controlling the price which is paid by the policyholder, so that the insurance contract is profitable. In segmentation, usually there are some active players and some passive players, and the active players, they do control and they take the good risks and they take correctly priced risk and they skim the market, while the passive players who do not move quickly enough, they remain with the bad risk and maybe not well priced, so that they can lose money. Well, segmentation is probably as old as insurance, but it in fact it received much media attention with the development of the GAFA, because most insurers are very concerned that using deep learning techniques and web surfing data, web browsing data, the GAFA can have a very much finer segmentation of insurance risks, and then that they could provide insurance contracts in a more competitive way than traditional insurance. So far, it has not been the case, but it might happen in the future. But in fact, there is a limit to this segmentation phenomenon, and that limit is easily understood when you still refer to the central limit theorem, because you remember, for the central limit theorem to work, you must have a sufficient population. And so if you break down your overall population into subpopulations, and if you discriminate perfectly among them, you might be left with very small groups in very small cells, and those small cells may not be enough for you to use the central limit theorem. So, well, there have been many, in fact, funny examples, which I may provide the detail next time, or I may send you the detail. So there have been many examples which have shown that, in fact, segmentation after a certain point, segmentation becomes non-productive or even counterproductive, simply because the cells are too small, and central limit theorem doesn't work, and there's too much variability, and overall it doesn't work. So there is an optimal level of segmentation, but it's very difficult to formalize that optimal level. And so far there is no appealing theorems which shows how to optimally segment when, for instance, when the risk is continuous and when there is some uncertainty about the class of risk. Okay, because of course, if you have perfect knowledge of the risk, it's far easier. But if you don't, the uncertainty and the learning process and the non-ergodicity makes it usually too difficult to discriminate, to attain a very high level of segmentation. Well, okay, I'm saying this, but when you look at actual motor insurance pricing schemes, it is not unusual that there are more than 1 million cells. Okay, that is to say, there are more than 1 million different prices for insurance because of the number of cars involved, number of categories of people, of geographical locations, etc. So there is segmentation, but the point is that finding the optimal segmentation is, at the moment, is not formalized. So this might be an area for research, an avenue for research. And now there's a French specialty, which is the bonus-malus system, which do not exist outside France. So to make a long story short, this was invented by GMF, la Garantie Mutuelle des Fonctionnaires, in 1939, in a time where not many civil servants had a car, of course. But the idea was not just, well, on the one hand, it served to segment among customers, as you will see, but on the other hand, it was also a reward scheme to retain the best customers. So basically, it was an instrument for segmentation, but more or less for, the idea was to make segmentation automatical so that bad risk would leave. Okay, and it was made compulsory by law in France in 1976. And the reason why it was made compulsory by law is simply to allow comparability, because if every insurance has a different bonus-malus scheme, then you cannot compare between insurers. So how does this work? In fact, you start at 1, that is to say you start at the 100% premium, which is 100% of the actual premium. And then every year without accident, you have a 5% discount. By 5%, I'm not meaning, well, I should say 5 percentage point discount. That is to say, the first year 5%, then 10%, then 15%. Then after 10 years, you got a 50% discount, and you cannot have a better or a larger discount. 50% is the maximum. Now, every time you have an accident, where you're liable for the accident, of course, then you have a 50% penalty, and this can go as far as 25% penalty. And of course, that penalty will then be eroded if you don't have any accident. Okay. 70% of drivers in France enjoy the maximum discount. That is to say that, in fact, the distribution of bonuses of bonus and malus is not at all. Is very skewed. Okay, that is to say, most people get the largest discount, and only very few people do have a maximum penalty, but some do still. And usually the problem with those who have the maximum penalty is that nobody wants to insure them. Because everybody, if you have, maximum penalty means that you have had 10 car crashes without any year without crash since then. So it makes it difficult. So usually when you're in this case, since nobody wants to underwrite you, you have to go to the Bureau Central de Tarification, and the Bureau Central de Tarification will say, in fact, it will choose an insurance company for you, and that insurance company will be forced to sign you, to write your contract, and the contract will be valid as long as you don't have a crash. If you have a crash, then the contract could be cancelled. Of course, the insurer will pay, but the contract will be cancelled, and you'll have to find another insurer, which you won't do directly, so you will have to go back to the Bureau Central de Tarification to designate another insurer, etc. Okay? The funny thing, in fact, or the thing that nobody ever says, is that the most interesting feature of this bonus-malus scheme is that it is a strong incentive not to report small losses, because if you have a small problem which would cost you a couple of hundreds or maybe 1,000 euros, if you do say that you have an accident, then you'll be reset at 100%. You will lose your bonus, and of course, losing your bonus in the medium term is not interesting. Hence, you will censor the small losses. I haven't seen the question, sorry. What happened in 2015 to pay for the victims of the terrorist attack in Paris? Did the state have to insure every losses? How do they choose the company? Well, I'm sorry, because in fact, I haven't got at what time the question was asked. Anna, your question about who is choosing the company. But now for the victims of terrorist attack, there is a GAREAT. The GAREAT is a special fund which was set up by law in order to compensate for the victim of terrorist attacks. So this is a special scheme which is organized by the state, but which is and run by a special entity which is organized by the state, but eventually it's funded by a tax on insurance contracts. So that's it for terrorism. And Anna, I don't know what company you're talking about. I'm sorry. Maybe okay. You said Bureau Central de Tarification. Okay, that's a good question. In fact, I never thought about this. Well, I will check. I will check how the Bureau Central de Tarification does. Let me write it so that I... No. Wait for me to do it before you thank me. That's more prudent. I'm writing it down so that I won't forget. And then of course the future of car insurance. This is just as perfect segmentation. It's one of the obsessions of motor insurers. Just because, as you remember, motor insurance is more than a third of overall property casualty insurance. Hence, motor insurance is a very large market. It's more than 20 billion premium every year. So that insurers are very concerned with either competition or technological evolution. And of course, in the case of driverless cars, who will pay for insurance? Because there is no longer any driver. So if there is no driver, who is liable? And who will pay the insurance? Well, add on top that the problem will be that probably there will be less damages, less losses to pay for, hence less turnover of insurance. Because, by the way, every year the losses are falling. But the case of driverless cars is a bit complex right now. In fact, the German industry set up a panel in order to settle the questions which arose and to rule the various cases and to prevent future litigation, so that the Deutsche Versicherungsbund now has an answer about who is liable in every possible case. Because the problem with driverless cars is that there is no driver, but the owner can be responsible in case the car is not properly maintained. The builder of the car may be liable, but the provider of software might be liable. The provider of data might be liable as well. The providers of captors of sensors, can be liable, etc. So there are many parties, so the German, they have made not just an attempt, but they have their own scheme. I don't think the same applies in France, but whatever. This is probably the future of car insurance, but albeit 10 years ago, the insurers were quite sure that the driverless car would be happening by 2020. Right now, what we see is that the driverless car will not be simple as it looks. And albeit some cars feature some automatic driving properties, they are not really driverless cars because you still must drive in many risky situations. Okay, so now the housing insurance is the second largest insurance class in the property liability insurance. And housing insurance, well, we shall distinguish between insurance of the premises, which is mandatory for tenants in France, okay, l'assurance des locaux, and insurance of the contents of the premises. Because, for instance, in case of a theft at your home, insurance of the premises will pay for the lock, okay, and for the door in case the door has been smashed, or for the windows if the window has been broken. But it will not pay for what was inside the house. So usually there are two sets of guarantees: one set of guarantee for the premises, and another set of guarantee for the content of the premises. We have seen that in case of liability insurance, there was a scheme as to who was responsible for paying according to the circumstances. In the case of housing insurance, there is a convention between insurers, which is the IRSI convention, Indemnisation et recours des sinistres immeubles. It superseded the former insurance convention, but the reason why there is such a convention is that, in housing insurance, most problems arise out of flooding of your neighbors, and the problem is that usually when flooding happens, it might lead to people fighting about the liability, etc. So the idea was to completely avoid that kind of fight between neighbors, and with the IRSI convention, as well as with liability in general, you call your own insurer, and then your own insurer does everything, well, up to a certain amount, of course, because in case someone set the whole house alight, or detonated an atomic bomb or whatever, this might be a bit different. But for usual losses, your own insurer will manage, and then you will manage with the other insurer, especially when there is no insurer. Okay, but so this is covered by the IRSI convention, which is specific to France, and the problem there is that every single country in Europe has a different way of working that issues. Okay, so therefore, insurance is very local because that kind of stuff is completely specific to a given country. And it's one of the numerous specialties that we have in France is that according to a doctrine, which was, doctrine, okay, according to a point that was made by the Ministry of Finance in 1889 for the centenary of the Revolution and especially the Exposition Universelle, okay, the state is its own insurer, which means simply that the state doesn't pay insurance premium. Hence, the point is that whenever the state is liable or whatever, he must pay out of his pocket. Therefore, he's not willing to pay, usually. So the reason why this doctrine was put forward by the Ministry of Finance is simply that, of course, the richer you are, the less willing you are to pay for insurance, simply because you do have the financial surface and you have the deep pockets to pay for compensating the claims, so that probably there is no need to pay for marketing costs and administrative expenses and profit of the shareholders, etc. Maybe it's enough to pay for the compensation. Albeit when something really severe happens, such as the fire at Notre Dame, you would probably prefer that someone else would take care of not rebuilding the building itself, the cathedral, but paying. You would prefer someone else to pay, because in Notre Dame the losses are expected to amount to are more in the field of billion than in the field of hundreds of million. Okay. And think about nuclear plants. What would happen if a nuclear plant detonates, such as it happened in Fukushima or worse in Chernobyl? But as you probably know, the French nuclear plants are completely safe. So we don't have to worry. And now, of course, part of an extension of the housing insurance is the Nat Cat insurance, which was enabled by the law of July 3rd, 1982. It was just before the national holiday of the 14th of July. We decided to compensate for every damage sustained because of a natural disaster, as long as there was an interministerial decree. En français, on dirait un arrêté interministériel. That is to say, a compensation for natural disasters will be enabled when at least two ministers sign together a decree which states exactly what will be paid for. Okay, and once the decree is signed, then the insurer will compensate, as long as you do have either a housing insurance or a car insurance. Okay. For damage to for losses to your car, and then the funding or the refunding of the insurance will be done through a tax on the motor and housing contracts, which will be signed, written, or sold on the next year. So this is not exactly an insurance scheme, because by insurance usually we mean that you pay your premium and then you get a compensation. This is more or less a pooling scheme, which funds the compensation, but the funding is done after the balancing of the expenses is done after the money is expended. It must be here said that one reason why the states loves the natural disaster insurance is that in fact it provides in the law there is some provision of emergency funding for the state itself, so that the state can expend money under this this scheme, and that money is not exactly negligible because it's more than $1 billion per year, which is at the disposal of the préfet. And for this reason, the préfet love the natural disasters because they are given extraordinary means, and especially extraordinary cash money, which can be used to rent helicopters and whatever, and to be the important man for some time. Okay. So in fact, it has not much to do with insurance in this case, except that the insurer are supposed to pay. Okay, so it is insurance in this respect. Well, now I won't be going into health insurance, etc. Not just that I did not find the proper slide. Have you seen that? I had a nice slide for housing insurance and motor insurance, etc. But there is nothing for health insurance. It looks more or less like a virus. So it's disgusting, and so I'm not going to talk about disgusting things. No. No, my point here is essentially it's not about the slides. Oh my God, it's 4 to 10. No, it's not about the slides. It's also that in fact health insurance is really heavily regulated, and regulated simply because the percentage coverage by category of items. I mean optical, dental, audio, etc. stuff, and drugs, etc. This is completely decided by the state. Hence, it's full of details, which I don't think are really interesting, unless you're in the business, of course. It's full of details, and those details change regularly because the state tries to make their interest pay as much as possible, so that the deficit de la sécurité sociale does not grow larger, and so this again is, well, this is insurance, but the detail is not fascinating. What can be fascinating though are perspectives, because if you think, for instance, of the Obamacare, understanding the mechanism is interesting. For instance, the point with Obamacare is that, as you probably know, in the US, the basic safety net provided by the Social Security is really minimum, okay? Because the Social Security works only for elderly people under the Medicare, and for very poor people under the Medicaid programs, but which are so basic that usually people are denied the most basic care. And during the pandemic, for instance, those facilities had to be expanded via direct payment by the state. Okay, but the idea with the Obamacare was to make private insurance available to low-income people, which were not able to pay for their own insurance because the salaries are not enough in the US to pay for decent insurance, so that basic health insurance was cross-subsidized. That is to say, money was taken from the richest customers to fund insurance for the less affluent customers. And of course, insurers who were selling insurance contract to the richer individuals, they were not willing to pay a tax to insure policyholders that were not, giving a profit. Therefore, they opposed the Obamacare. But what is interesting there is that you clearly see a cross-subsidizing principle, and then you clearly see that something is at stake. While when you state, that from here on the drugs will be paid back at only 65% instead of 68%, this is not that interesting. So we're not going into that kind of details anymore, nor about life insurance, because if we think of the tax shell, which is the heart of life insurance in France, this also is about fiscal details. So we're not going to have a look at this. Next time we're going to look at life tables and actual calculation in life, and that will be enough, and that will be maybe more interesting than les barèmes de remboursement de sécurité sociale. Bon, thank you for your attention. Have a nice day. And stay safe.